Bitcoin has underperformed my expectations in this particular cycle. I started out with conservative expectations, which was I thought the 2021 cycle, I thought we'd get to $1 trillion market cap. We did. Once we got there, I was like, yeah, I could see us hitting 100K this cycle. We did, and we only got to like 69K. So my kind of revised bullish take wasn't quite met. Yeah, the way I look at it is that, so in the early stages, obviously the 4-year cycle was impactful because the new supply was so large and meaningful that a half reduction in that new supply really affected market dynamics and could be a catalyst for the next bull market until that euphoria gets overdone. Now, as the new supply has gotten so small relative to other factors like the rate of OG selling or not selling, the rate of big new buyers coming in, these are all much bigger factors than the new supply that comes from Bitcoin in a halving.
Alden begins from a macro premise. As the global monetary system becomes more multipolar, it makes sense to hold scarce, non-sovereign assets. Her initial thesis centered on gold. That was the logical first step. Gold has thousands of years of monetary history. It thrives in environments of currency debasement and geopolitical uncertainty. But as she studied Bitcoin more deeply, she came to view it not as a replacement for gold, but as an extension of the same thesis. A decentralized ledger capable of enabling permissionless payments and portable, secure savings introduces something fundamentally new to monetary design. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So I've been in the camp that as I see this world get more multipolar, it's hard to know the time frames that these things happen on, which is, it's funny because some Bitcoin proponents really don't like gold. Some gold proponents really don't like Bitcoin. I've been in the camp that likes and is long both. In fact, I've been long precious metals longer than Bitcoin because initially my thesis was, okay, this is all happening. I'm going to go own gold. And then as I learn more, I'm like, well, okay, I'm going to add Bitcoin to this thesis too because it's, many ways better. So it has, it's been Bitcoin's outperformed during that time, even though it's underperformed more recently. And to answer the other question, I have been, Bitcoin has underperformed my expectations in this particular cycle. I started out with conservative expectations, which was I thought the 2021 cycle, I thought we'd get to $1 trillion market cap. We did. Once we got there, I was like, yeah, I could see us hitting 100K this cycle. We did, and we only got to like 69K. So my kind of revised bullish take wasn't quite met. Even my first one was. Then we go into the bear market. Then I basically said, I'm not really going to try to make a price target this cycle, but when pushed, I would say anything under 150K is kind of disappointing. And we only got to 126. So I would say it is kind of a second, kind of a lackluster cycle. I think Treasury companies took some of the euphoria out of it. So some of the money that might otherwise have gone into, say, just cold storage Bitcoin goes into, leveraged shares of these treasury companies that are trading at X times, MNAV, which takes some of the price action out. So I think maybe without those, you could have gotten a little higher, but then also they were also partially fueling the buying of it to some degree, especially MicroStrategy. So yeah, I think that overall this was a somewhat disappointing cycle. It doesn't change my long-term thesis about it, that basically a decentralized ledger is still very valuable. It's the only way to do, that we know of to do permissionless payments and portable secure savings. And then the second part of the thesis is, well, that these things have network effects. So you pick one that you view as decentralized, secure, and is likely to win basically the liquidity war, the network effect war. Obviously, we had disagreements around, say, Bitcoin versus Ethereum and others. I've been in the Bitcoin camp, which is, okay, so a decentralized ledger is valuable. That's the largest, most liquid one. It's kind of the one that's kind of geared towards simplicity and kind of maximal decentralization. And so the thesis is that would continue holding up, and also has bullish on stablecoins along the way as well, even though they run on largely other rails. And I would say in this cycle, Bitcoin is still dominant cryptocurrency. So 17 years in, I think that part of the thesis continues to hold up well. People have their views on quantum and other factors that contribute over the next 5, 10, 15 years. But so far, I'd say that part of the thesis is on track. And the part that's going slower than expected is just the demand for any decentralized ledger, which is, I still think it's valuable. But I do think the world's kind of maybe a little slower to recognize its use. And a monetary asset, unlike, if you're out of oil, you have a problem like that day. Whereas if you haven't recognized good money yet, a lot of people, they're just not harmed by not, it takes time. It's not like someone can have a Bitcoin shortage. So unless you're an exchange or something, like it's like there are people that are blocked from making payments, and they get around in other ways. Sometimes maybe they haven't found the best way yet. There are a lot of other people that say, well, debasement's happening, but my payments aren't shut off. So as long as I own AI stocks and gold and stuff like that, I'm fine. So I think these things can take quite a while to play out. So I think the long-term thesis is intact, but it is true that it's underperformed my expectations this cycle. And the softening blow is that I have been in the camp that you can own multiple things. I've also, my history more starts with equity analysis. So I'm also long stocks to a very significant degree. So when you have stocks, gold, Bitcoin, and some cash liquidity, you generally get through these things pretty well.
In Bitcoin's early years, the halving cycle was materially significant. Cutting new supply in half had a measurable impact because issuance represented a meaningful portion of total circulating supply. But as Bitcoin matures, new issuance has become small relative to other flows. Large holders selling or not selling, institutional inflows, leveraged speculation, ETF flows, and corporate treasury allocations. From a fundamental standpoint, Alden argues that the halving is no longer the dominant driver.
Yeah, the way I look at it is that so in the early stages, obviously the 4-year cycle was impactful because the new supply was so large and meaningful that a half reduction in that new supply really affected market dynamics and could be a catalyst for the next bull market until that euphoria gets overdone. Now, as the new supply has gotten so small relative to other factors like the rate of OG selling or not selling, the rate of big new buyers coming in. These are all much bigger factors than the new supply that comes from Bitcoin in a halving. And so fundamentally, I don't think there's any reason to have the 4-year cycle expectation in play. I do think that behavior tends to change with a lag from fundamentals. So even though the 4-year cycle, I don't think it mattered fundamentally this cycle, and I think the last cycle still probably wasn't the biggest factor, but was a little bit more of a factor than this time. I think it takes a couple cycles for the psychology to catch up. And so I do think that there was some self-fulfilling prophecy, which is that people say, well, if Bitcoin's only going to get this far this cycle, and then I'm risking a 2-year bear market, might as well get out now and see if I can buy back later. And if enough people think that, then you get that happen. And then, of course, when it's down versus expectations, you have some people panic sell or get liquidated if they were leveraged. So then it feeds on itself. And you clean out pretty much anyone who owned it for the wrong reasons or that owned it on too much leverage. The one part that I have been careful of is, it was about this time last year, I would get on podcasts all the time, and people say, well, what do you think about the sovereign Bitcoin reserve? And that's the part I would kind of push back on and say, any of my models are not going to include it because I'd rather be surprised to the upside than surprised at the downside. My default view was, okay, they're probably going to ring fence the Bitcoin they already have. They've largely done. But that I wouldn't bet the farm that they're going to go out and buy 500,000 coins, regardless of what some of the proposals were, just because the status quo for governments is no change. Now, obviously, in a Trump administration, there's more variables. We just talked about how just rapid things can be. So if you ask me, would the tariff war have gotten this elevated a year ago, I probably would have said it wouldn't be my base case, right? So that hit kind of the unusual levels, but the Bitcoin sovereign Bitcoin reserve didn't. So I think it is right to be cautious on expecting one big pool of money to come in and save a cycle. It's nice if it happens to the upside if you're long, but I wouldn't bet on that. Instead, I think you want to have conservative expectations and be more, just like prudent with expectations. I think that we've generally seen, so obviously there's career risk, right? So if you're a central banker and you buy Bitcoin and the Bitcoin goes down, you probably lost your job. Same thing if you're a corporation. So generally speaking, the ones that do it are ones that operate like an individual or a small company. It's because some owner like some CEO is like either the founder or a major shareholder, unlike most corporations where the ownership is pretty diffused. So someone like a Saylor, someone like a Bukele, that they have kind of a higher than normal level of control of the entity that they're overseeing, and that they can make maybe not fully unilateral decision, but closer to a unilateral decision to do something the way that a small business or an individual might operate. It only takes you or you and your spouse to make a decision. And I think that that's kind of the cycle we're in. Now, no one followed strategy really in that first cycle they did it. Now, obviously, we've had more imitators this cycle, for better or worse. So I think these things take time to catch on. So every cycle, I think you probably would get more of them. But I wouldn't bet the farm on like any one giant one saving a whole cycle. So I think it pays to be kind of prudent with expectations. So I would separate strategy from most other treasury companies, and I probably would put Metaplanet in the more stable one too, which is that there are several of them that I'm worried about. I mean, basically, I think they got way overdone, didn't structure themselves super well, expected the bull market to go on longer. Strategy, obviously the share price taking a massive hit. If you look at their actual debt ratios, they're still pretty reasonable, even after the sell-off of their collateral. And I think one of the best decisions they made was they made that dollar reserve, perhaps somewhat ironically, but they have this dollar reserve that can cover currently approximately 2.5 years of their preferred dividend payments. And then their convertibles are a pretty small percentage of their asset base and are not due for a number of years either. So they've kind of structured themselves for a pretty big drawdown. And I've gone on 2 of their earnings calls as an analyst. The one was 6 months ago, and I asked about stress testing, like downside scenarios. You're right at the euphoria phase. And I was like, well, if everyone's going to ask bullish questions, I'm going to ask the bearish questions. Like, how are you thinking about stress testing this? So they basically said they were trying to gear toward 80 to 90% drawdowns and still be, solid. So we'll test that. But, so far it's gone down pretty far and they're still functioning. And I don't really see anything breaking them in the next few years, especially now that they have this kind of dollar reserve. Obviously, if you were to have like a 5-year plus bear market, if you fast forward to like early 2030s and we're sitting at like $40,000 per Bitcoin, they're probably massive trouble. Yep. But I don't see them in sort of near-term trouble. But then I would separate that from like weaker ones that have just not structured themselves, that don't have the liquidity network effects of MicroStrategy, that maybe haven't termed themselves out with like long duration convertibles or preferreds, or they got over their skis in other ways. As far as quantum goes, so my view is that, fundamentally, I'm not worried about it in any sort of investable time horizon, call it 5-10 years. Bitcoin being rather decentralized tends to upgrade slowly and take a lot of consensus. And of course, it's a complicated problem because quantum resilient signatures take up a lot more space. So when you have a pretty limited block space, this is a trade-off. And then there's debates that are way higher than my technical pay grade, which are what is the best signature scheme, in quantum to make it, what is the most efficient way to do it, or the best blend of security and efficiency. And that's still being, determined and litigated over time. Now, I'm personally, bullish on both. I think it's going to take quite a while for quantum computers to attack Bitcoin. And I do think that Bitcoin has plenty of there are people in place already trying to figure this out. And I do think that as it becomes, if it becomes more urgent, I think they would figure it out. That being said, I've got a lot of contacts in institutional, firms. And over the past 6 to 12 months, the quantum risk has hit them in a way that it wasn't, maybe a year ago or more. So it does, I would say it has affected their buying or selling decisions, at least around the margins. And one way of thinking about that is if they say there's a 10% chance that something happens in the next 10 years, and they'll say, I don't even know how to handicap that. I don't know if it's 5%, I don't know if it's 2%, I don't know if it's 15%. They say there's this kind of variable there that is just outside of our technical pay grade to know. And so when you build an expected value model, like a lot of firms will say, here's our bull case, base case, and bear case. They can make their bull case and base case the same as they were, all for the macro reasons and all for these other things. But then in their bear case, they say, well, let's say an X% chance we get zeroed out, or X% chance there's some like messy chain split where one's trying to be quantum resilient and the other one's not, and then this all hits and we lose 80% of our value, they have to like fatten that left tail bear case, which then brings down their average price target or makes them say, well, we might have put in a 5% position, but now we're going to put in a 3% position, or maybe just it doesn't get past committee and you would have had, 5 out of 9 votes to get it in there. And now you've only got 3 or 4 votes, so it doesn't go in. So I do think that even though I think that the technical threat is able to be mitigated, I do think that it actually has impacted price this cycle.
The takeaway from Lyn Alden's framework is not exuberance. It is discipline. Bitcoin remains the dominant decentralized ledger. Its network effects are intact. The structural case for permissionless payments and portable censorship-resistant savings remains compelling in a multipolar world. But adoption is slower than enthusiasts hoped. The halving's influence is diminishing. Treasury companies alter market structure. Sovereign adoption is uncertain. Quantum risk, even if distant, affects institutional models today.